What's up, everybody? Welcome back to The Truth About the Market, where we cut through the noise and talk about what's really happening in aviation. Not the hype, not the headlines, but the truth. I'm your host, Jason Zilberbrand, president of VREF. I've appraised just about everything from Cessnas to Gulfstreams for clients that range from the FAA and SpaceX to celebrities and Fortune 50 companies, as well as the industry's largest fleets you've definitely heard of. And most importantly, I've owned and sold and operated my own aircraft. And equally important to that, this podcast is sponsor-free. No commercial paid-for opinions, no spins, just the unfiltered truth. And today we're talking about aircraft finance. Brokers, credit unions, banks, capital companies, who to use, when, and why. This episode is unique because I am going to name names, and I'm going to give you a list of participants in the industry by segment. But before we get into the names, who to use, who to avoid, and where people get good results, I need to make one thing very clear up front. I am not sponsored by anybody in this episode. I don't receive referral fees. I don't get paid for my recommendations. In fact, not one name mentioned in this podcast was aware of their inclusion in my list. I also want to point out this is a long episode. It's really impossible to cover such an important topic quickly. And even with the amount of time that I have allocated, I know that there's no way I can mention every player and every lender, what makes them special or unique. So you need to know this. You can email me offline. I will help point you in the right direction, jason@vref.com. So with that, the people and the institutions I'm going to talk about today are ones I've seen perform over and over and over again, repeatedly, over numerous multiple market cycles, ups and downs, valleys and troughs. They get it done. And that matters because aircraft finance is one of the most misunderstood parts of aviation ownership. And not because buyers are sophisticated or unsophisticated. It's because the system itself is very opaque by design. Most people come into aircraft financing thinking it works a lot like a mortgage on a house, and it doesn't. Because in residential lending, the house is the collateral, the market is deep, it's transparent, and it's liquid. Banks understand exactly how fast they can exit and at what discount and under what conditions. Guess what, folks? Aircraft lending is just the opposite. Banks are not underwriting your mission or your passion or your dream airplane. They are underwriting exit liquidity. Let that sink in. How fast can they sell that aircraft, in what market, and how painful that sale would be if they had to do it tomorrow? That's the part no one wants to explain clearly. Because the airplane is not primary collateral. It's conditional collateral. What does that mean? It means that the bank is really lending against you, your debt-to-income ratio, your credit score, how stable you are. And then with the aircraft, its market depth, transaction velocity, historical price behavior, supportability of that aircraft type, and how ugly the downside looks in a stress scenario. And that is why two borrowers with identical credit profiles can get widely different terms on the same aircraft. And that's also why buyers walk away confused and frustrated or convinced the system is rigged. Look, it's not rigged. It's just not designed for transparency. But once you get past the basic credit threshold, and if you have a clean history and adequate liquidity and reasonable net worth, look, your personal credit quality matters less than what people think. What matters more is whether the bank believes it can exit the airplane cleanly without becoming an aircraft owner, right? No bank wants to own an airplane. And here's an anchor point to keep in mind throughout this episode. If a bank can't sell the airplane quickly, you're paying for that risk, whether you see it or not. You might pay for it in a rate. You might pay for it in structure. You might pay for it in covenants. Or you might pay for it later when you try to refi or exit and discover that the loan you thought was so great has a lot of teeth. More on this later. So if aircraft finance has ever felt confusing or inconsistent or arbitrary, that's not on you. It's because most of the industry explains the process backwards. So today we're going to flip it around. We're going to talk about how it actually works. Then we'll talk about who navigates it well and who doesn't, and why right now is one of the most interesting windows we've seen in years for buyers and refinancers to understand the rules. So let's talk about the difference and why it matters, right? What is the difference between a bank and a finance company and a capital company and a credit union? So, one of the biggest mistakes I see buyers making is assuming that all lenders are the same, and they're not. And who you borrow from is often matters a lot more than just the rate. So let's start at the very top. Let's talk about a bank like Bank of America or PNC or JP Morgan or Citibank. They take deposits, they lend against them. That means that they're highly regulated. That means that they're also risk adverse and they have processes, and those processes drive the banks. And the banks care about consistency and policy and reputational risk. They don't need your deal. They need deals that fit into their box. That's why large banks often don't use brokers. They already have capital, distribution, and brand power. Brokers in this scenario add risk, not value in their view. A finance company, well, it's different because they don't take deposits. They borrow against money and then they re-lend it. And because of that, they're more flexible, they're faster, they're more creative. But they're also way more expensive because finance companies often do use brokers, and because brokers bring deal flow, and deal flow is how they survive. And if you're wondering about where brokers fit into all this, I'm going to go over brokers as well a little bit later on in the podcast. So, a capital company or a private credit firm is even more opportunistic because these groups manage investor money and price for risk, not relationships. They'll do deals that banks won't touch in a million years, but you'll feel it in structure, you'll feel it in covenants, you'll feel it in pricing and fine print. Brokers are essential here because without a broker, there is no access to their product. So keep that in mind. And then a credit union. A credit union is member owned. They're relationship driven and they often offer excellent pricing, but they're also constrained by a charter and geography and internal expertise. Many can't legally use brokers at all. And then some of the larger ones rely heavily on them. That's why credit unions are fantastic, in my opinion. And it's an excellent alternative to a bank because credit unions are also embedded in every commercial airline. They finance aircraft for pilots with ease. I do a lot of these appraisals, folks. So if you're a pilot for United or American Airlines or Southwest, you have a great source for lending internally. You can go get a trainer aircraft. They're going to still require an appraisal, but their lending process is a piece of cake. All right, so let's go back to banks for a minute. Big, small, first tier, third tier, we hear it all the time. What's the difference? So the difference between a Bank of America and a regional or a second tier bank is scale and tolerance. Large banks have endless capital, but very narrow lanes that they operate in. Regional banks have less capital, but a little bit larger of a lane or more flexibility. And a third tier bank may stretch even further, but they're also more exposed when cycles turn. Most banks want you to have an established relationship, a history of deposits, a great credit score, and they often won't lend above your portfolio limits. But if you qualify, it's simply a phone call when you deal with a bank, right? They want the business from a select few who are gold bond, AAA, risk-free in exchange for great terms that are super favorable to the borrower. And the takeaway is simple. The best lender depends on the asset. And we're going to get into this because it really does matter about the aircraft type and the cycle and your risk profile and whether or not you have an existing relationship. Because a fast approval is not the same thing as a good loan, and knowing who really is lending the money is everything. This episode is brought to you by VREF, the trusted name in aircraft valuations and appraisals. Whether you fly a piston single or manage a business jet fleet, VREF keeps you grounded in data that matters. So visit vref.com to know what your aircraft is really worth before you buy, sell, or finance. Okay, so we talked about the types of lenders. Now, let's switch it. Let's talk a little bit about brokers because this is where aircraft finance gets really murky and confusing fast. So a good aircraft finance broker can absolutely save your time, save you money, save your bacon, if you really want to know the truth, because they can package your deal, they can translate your story into bank language, and they get in front of lenders who actually close and like the type of aircraft you're buying. That's the value they bring to the table. But we need to be crystal clear. No broker works for free. So the question is whether their incentives align with yours. And there are three common ways that brokers get paid. They get paid by the bank with points. And this is the most common, and it's why people think that the broker is free. So a point is 1% of the loan amount. So on a $200,000 aircraft, the financed amount might be $160,000 if you're putting 20% down. So the $200,000, if you're financing the full purchase, which is less common, but it does happen, but that money doesn't come out of thin air. It's paid out of the economics of the loan, right? So 1% of $160,000, that's next to nothing. And I think you would agree that they definitely are earning their money in that case in terms of a commission. The second way that they can make money is called a rate spread. And this is much rarer, especially in piston aircraft. And I don't really know of anybody that's doing this in the small aircraft types. Maybe they are. I'm just not aware of them. But a rate spread is sometimes the bank will approve you at one rate and then the broker will quote you a higher one, right? And they're going to pocket the difference. The difference is their revenue. So example, you qualify at 7.75, but you're quoted 8.25. So that's a 50 basis point spread. And so that 50 basis point spread on a $200,000 loan over 15 years comes out to about $57 a month. I mean, we're really not talking about a lot of money. But you can see on a $1 million loan, maybe the $250 a month really bothers you. Personally, it wouldn't bother me. I think they're earning their money. It doesn't really sound terrifying, these numbers. The problem is that you got to look at the big picture. So, that $57 a month that you're paying over 15 years, if you were to go full term, which you never would, but let's say you did, you're paying about a $10,000 premium because you had a broker involved. And that's just a half point. So when someone says the broker is free, what they really mean is you may be paying them inside the rate instead of writing a check at closing. That's a big difference. It's a big deal. You might not look at it the same as money out of pocket, but it is. The third way, and this is where you really need to pay attention, and I can't tell you if I've ever seen anybody try and do this outside of older business jets, but this is called the bank point and Bauer, where a broker will collect bank paid points, and then they're going to charge an origination and a processing fee to you on top. You see this sometimes in the commercial world, but it's not automatically unethical, but it's very non-transparent, if you ask me, because there's no guarantee when you pay those origination or processing fees that the bank is going to step up and fund. So, if you look at it this way, because I kind of tend to do, they could do 15, 20 of these types of deals every quarter, just charge you origination fees, never lend on anything, and have quite the nice business model. So get referrals. Ask who these people are lending to. You're entitled to know. Bottom line, brokers are not villains, but the system rewards them for closing loans and not for optimizing your long-term outcome. Your job is to make sure the structure and the incentives line up with your goals, not theirs. So who should you use? Great question. And I am going to name names, but before I do, I want to explain why I'm comfortable doing this, because it's rare that I will ever do this in a public forum like this. The brokers I'm about to mention all share a few critical traits that matter far more than rate quotes or marketing polish. They are organized to a fault, if you ask me. They're transparent about the process. They respect the buyer and the seller's time equally. They understand that a valuation is not a formality, it is risk control. They know how to run a transaction without creating unnecessary friction for the seller and the buyer, the banker and the appraiser. Most importantly, they understand that VREF is not an obstacle to financing. It's a critical component of getting a deal closed cleanly and quickly. These brokers all consistently do the same thing. They provide a complete, well-organized aircraft spec package, deliver documents once, not piecemeal. They use shared folders like Dropbox, so everybody's working from the same data set. They don't drip feed requests. That annoys the hell out of sellers. It confuses buyers. And they understand how banks actually consume valuation data. That alone puts them ahead of a large portion of the market. So here's a clear, repeatable breakdown of the finance brokers I trust in the piston and turboprop and light jet aircraft transaction markets and why. But I want to make sure that I'm telling you that I'm doing this in no particular order. I swear to you, it's alphabetical. It's only fair. I don't, when somebody asks me to refer them a broker, they get this entire list. They don't get one. So the people who are on this list, congratulations. I think you guys do a great job. If you're not on the list, then I'll say it again later. This is not a slight. I am not disrespecting you. I either didn't have time or honestly, I don't work enough with you to refer you out. If you're not on the list, call me. We'll get you on the list because I'd love to work with you. Okay. So with that being said, here we go. Currency Air in the number one spot based on alphabetical order. I like Currency Air. Kathy and Nolan are great. They do straightforward piston transactions. They do them with clarity, transparency, disciplined documentation. All the documents are always really organized. Kathy really brings a controller's mindset to every deal. And I like that. I like the fact that there's a complete package. I don't have to ask for things. It's all there. Everything stays aligned right through closing, and everybody is communicating with everybody throughout the transaction. In the number two spot, based on alphabetical order, is Flying Finance. Kimsey is fantastic. Repeat buyers, experienced owners who value efficiency and decisiveness. I talk to them all the time. They refer a lot of appraisal work. They do a lot of deals. Kimsey understands aircraft classes, lender appetite, how to set expectations early. Deals move smoothly because nothing is left for the back end, including the valuation context and lender preferences, and there's no surprises. In the third spot, alphabetical order, is Steel Aviation and Megan Strader. Megan is great. You know, if you're looking at owner-flown piston aircraft, especially Cirrus's, they are a Cirrus specialist. They get it. They understand the used market better than anybody. First-time buyers who are looking to finance without stress, they're really good. They also work with a different group of lenders than a lot of the others, so they have places to go that you might not be aware of. Megan is highly organized, process-driven. She communicates all the time with all the parties, and more importantly, she respects market reality, which keeps underwriting efficient and transactions calm. In the next spot is Jet Loan Capital. Sam Harris. I've known Sam probably longer than anybody in the industry at this point. Sam actually used to finance my own aircraft when he was with National City. He's a banker. He talks the talk. He walks the walk. Jet Loan's really good at the 500,000 and up market, especially turboprops, especially owner operators. You know, if you're looking for a banker's perspective on a challenging deal, Sam's your guy. He's direct, he's transparent, he's analytical, but he understands how lenders think and he structures those deals accordingly. And what makes him a strong fit for buyers who want clarity and confidence throughout the process is the fact that he truly does understand that most of what he's going to get are challenging transactions. So understand you're not wasting his time. Call him. He might be able to help. And in the last spot that I have room to talk about today in alphabetical order is Susan and Craig Whedon, the Whedon team, aircraft lenders. They are fantastic, the dynamic duo. They handle more complex transactions. They can do aging turbine aircraft. They do turboprops. They deal with a lot of stuff that I think a lot of other brokers would either not waste their time on or certainly not have the expertise to deal with. They work as a true team. They're exceptionally methodical. They excel at managing expectations and navigating obstacles while maintaining valuation discipline and lender confidence. So the takeaway here, there isn't a best broker here. They're all excellent. The right choice depends on the aircraft you're buying and how complex the deal is, your experience level as a buyer, and how you prefer to communicate. So match the broker to the problem you're solving, not the rate you're chasing. So let's pivot for a minute or two. Let's talk about commercial use and lending, because this is where aircraft finance gets genuinely difficult and where a good broker is probably your only option. Actually, this is where brokers really earn their keep. Financing a personally owned aircraft, even for business use, is one thing, right? But for commercial operations, it's really, really another entirely different ballgame. Because the moment you start talking about a new helicopter for EMS or a business jet that you're going to charter out more than 50% of the time, the risk profile changes completely. And banks aren't just underwriting the aircraft anymore. Now, all of a sudden, you're asking them to underwrite the operator or the business model or regulatory compliance or utilization assumptions and operational risks that they don't control. And that's why many lenders won't look at these deals at all. If you mention charter, a large percentage of otherwise aviation friendly banks are immediately out. Not because the aircraft is bad, but because commercial ops introduce volatility, liability exposure, and regulatory complexity most balance sheets don't want. And the golden rule is if you need to rely on revenue to pay for the plane, it's a no-go right from the jump. So this is where an experienced broker matters. It's really not for rate shopping, but for knowing which lenders will even engage, how to structure the deal, how to speak the language of commercial risk. Commercial lending is not personal aircraft lending with a different label. It's really a different universe.
If you'd like a complete list of all the brokers and service providers, as well as bankers, that I referenced in this episode, then you can download a free copy at vref.com/resources.
All right. Before we move on, I want to talk about two categories of aircraft finance providers that consistently cause problems without naming names, because frankly, anyone who's been around this industry for more than a year already knows who I'm talking about. Look, it isn't personal. It's structural. It's the alphabet organization problem. Let's start with the big one. The well-known alphabet organization that positions themselves as a consumer advocate while being a member resource or a pilot-first solution. On paper, that sounds reassuring. In practice, this is where I've seen some of the worst financing outcomes ever. So here's the pattern. There's no due diligence. Valuations are treated as a formality because there's zero experience. And it's a herding mentality because volume is the key here, not solving your avionics upgrade or your engine overhaul or your refi. That doesn't matter. Little to no transparency about who the lender actually is, because you're going into a trough where they're going to shop it to a bunch of different lenders. The person you are speaking to, they're going to use a script, and probably they have less than 5 years experience in aviation or in business. And no one you deal with is a banker or a financier. They just push paper. And that is a process that prioritizes member convenience over financial rigor. But that's what bothers me the most. And look, it's amazing that these deals close. Somehow they usually do. But it's the buyers often have no clue what's going on and who ultimately holds the paper until closing. So what assumptions are they making about your credit, and what assumptions are they making about the value of the aircraft, or how exposed they are when the market shifts due to the fine print of their covenants? When a finance platform like this is built for scale and simplicity and branding, rigor is usually the first thing to go. And in aircraft finance, a lack of rigor doesn't show up immediately. It shows up when you try to refi or sell or restructure. That's not advocacy. That's complacency dressed up as trust. Okay. I think I beat that dead horse. Let's talk about the other one that drives me crazy. Let's talk about a category of intermediary, a broker that deserves real scrutiny and, frankly, more due diligence than most buyers ever apply. It's your favorite. It's my favorite. It's the overnight expert. You've seen them. They appear out of nowhere. One day they're selling something completely unrelated. They're not even in aviation. The next day they're suddenly an aircraft finance expert. They're not just any expert. They're all of a sudden a charter market expert, a piston market expert, turbine market expert, business jet expert. They offer services on yachts and anything else they can lend a buzzword to. They talk the talk. They know the buzzwords. They sound confident. But when you look under the hood, the fundamentals just aren't there. Because here's what proper due diligence will reveal. There's no meaningful reoccurring revenue from their finance activity. They don't do enough deals to matter. There's no E&O insurance or liability coverage to protect them or you from them. There's no balance sheet. There's no capital at play. There's no contractual responsibility if something goes wrong because they don't even have an office address. Nothing more than a cell phone, a laptop, and a smile, which raises the obvious question, when things get tough, what exactly do they bring to the table? Because in a real transaction, confidence isn't collateral. What I consistently see with this type is the same pattern. Minimal actual underwriting work, deals shoved into whatever lender will say yes, no understanding of valuation sensitivity or the pecking order in aviation, no awareness of exit or refinance risk, no long-term thinking behind getting the deal closed because they haven't been around long enough to look at this as anything more than a gig. Their entire model relies on personality over process. And to be clear, they're not bad people, but they're dangerous because when a deal runs into trouble, they're going to disappear. And that's the real red flag. Experience isn't how loudly someone talks about deals, it's who still answers the phone when the deal breaks. And in this market, confidence without competence doesn't just waste time. It costs money. It costs real money. It costs you real money because longevity in aviation takes more than a smile, takes willingness to learn while not stepping on the toes of those who came before you. So let me be very clear. I'm not saying these people never close deals. They do. What I am saying is that closing a deal is not the same thing as structuring a good loan. And that's the line I want you to remember. A fast approval is not the same thing as a good loan. If someone can't explain how the valuation was derived, why the lender was chosen, what happens in a refi, or how the loan behaves in a downturn, then you're not being advised, you're being routed. So let's talk about the banks when going direct makes sense and why not all banks are the same. Look, if you're tired of guessing aircraft values, try VREF Online. Real-time data, quarterly updates, over 900 models at your fingertips. From residual value forecasts to depreciation trends, it's the platform trusted by everyone. Every lender, insurance company, broker worldwide uses VREF. Subscribe today at vref.com. Start making decisions based on facts, not feelings, not AI slop. Okay, so let's talk about banks. Let's talk about when going direct beats using a broker, because there are situations when using a broker makes sense, and then there's situations where it doesn't. And this is one of those times. If you're refinancing, and if you're a strong borrower, and if you already maintain meaningful liquidity at a bank, going direct is often the better move, particularly for known aircraft models. We're talking about popular makes and models, aircraft with deep resale markets, typically aircraft 15 years old or newer. Look, now to be clear, lenders are still going to require an appraisal. That doesn't go away. But a refinance isn't really about proving the airplane. It's about lowering your payment and improving your structure and optimizing cost of capital. And this is where relationships matter more than the asset, because tier one banks understand something smaller lenders often don't. The deposits they hold are more valuable than the airplane they're lending against. And so for lenders that service top tier clients, the aircraft is secondary to the relationship. That changes everything. It's why pricing is usually cleaner when you go direct, because there's no intermediary margin backed into the rate. There's no incentive to push structure just to get the deal closed. It's also why covenants are often better, because these banks underwrite the borrower first and the airplane second. The loan is part of a broader relationship. It's not a standalone transaction. And most importantly, there's no incentive distortion, because a relationship manager is measured on long-term client health, not deal velocity. That leads to better decisions, especially when markets soften. This is also why the largest banks end up financing a really disproportionate share of aircraft across the industry, because they aren't chasing metal, they're supporting relationships. And when access to capital isn't the issue, adding a broker rarely creates value. In those cases, control, clarity, and structure matter more than speed, and that's when going direct almost always wins. Okay. This is where the episode is going to take a turn, and I think it's going to become very useful, because the truth is no lender actually disappears. That's not how this market works. But what really happens is more subtle and far more important, because some lenders simply stop winning deals, not because they don't want to lend, not because aviation suddenly became scary or there's no volatility. It's because the lender has exposure on its balance sheet. There are so many reasons why lenders stop, and it's often tied to appetite in the time of year. But because aviation lending is hard and only a small group of institutions are actually built to do it well, there's a very small list, right? So every lender on this list plays by a different rule book. They all have different doc requirements. They all have different financial requirements, loan to value limits. That's called LTV. You hear that all the time. They have interest rate bands that are different from one another. They have different age cutoffs. They have different tolerance for price and mission and usage and market. So there's no standard aircraft loan. That variation is not randomness. It's just how lenders manage risk. So here's the reality. To consistently finance aircraft, a lender needs 4 things. And if you miss any one of them, you're at a great disadvantage. First, Substantial institutional knowledge, because aircraft aren't generic collateral. Values move by model, liquidity changes by market, and maintenance events matter. The lenders that win understand aircraft markets, not just balance sheets, and that directly drives what documents they ask for, how conservative their LTVs are, and where their age limit cutoffs sit. Second, access to real capital, not conditional capital, not committee approved if everything goes right capital, actual balance sheet capacity. That's why some banks can offer longer terms, better pricing, or flexibility on structure, while others can't. Third, track record. Lenders that have been through downturns know exactly where things break. And that's why some require deeper financial disclosure, stronger covenants, or tighter advance rates, especially on less liquid aircraft. And fourth, and this is one of the most overlooked, access to data they can actually trust. It's not hearsay, not optimistic broker comps, but real market data that informs valuation sensitivity, their exit risk, and residual behavior. That data directly affects rates, structures, and whether a deal even clears credit. That's why deal volume matters. When you look at the last 6 months, the top 20 lenders include a mix of business aircraft banks, piston specialists, helicopter lenders, and even agricultural equipment finance groups. And while I don't have time to go through each one on the air, this list is far from a full universe. It does tell you who is consistently executing, because here's a fact. There are over 400 active aircraft lenders in the United States, each with a specialty. Matching the right lender to the right aircraft, to the right borrower, and to the right market environment is where deals are won or lost. And these numbers don't happen by accident, folks. These banks don't like airplanes in the emotional sense. They understand them operationally. Aviation lending fits inside their risk framework and their capital model and their data ecosystem. Specialty lenders play a different but equally important role, because aviation lending rewards institutions with knowledge, capital, history, and trusted data, the big four. Everyone else may still be at the table. They just don't win the deal. And that distinction matters far more than rates, especially when markets get tighter. So with that being said, here are the top 20 lenders in business aviation. In the first spot is PNC Bank. Then we have Bank of America, First Source, Salem 5, Regions Equipment, UMB, Scope, Wilmington, Enterprise Bank and Trust, Pinnacle Bank, JP Morgan, SunTrust, Service First Bank, City National, Huntington National, Community Bank, BOKF, which is the Bank of Oklahoma, Lake Michigan Credit Union, also known as NAFCO, Regions Financial Corporation, and U.S. Alliance Federal Credit Union, also known as USA Specialty Lending. These aren't all banks. There are some credit unions, but at the end of the day, every single one of these folks understands aviation. So I thought it would be fun to walk through the same aircraft with some different loan terms so you can understand and get a better understanding of what's really at stake. So I'm going to walk through a couple of aircraft values and walk through their financing. Quick sidebar, because you're going to hear this term a lot. It's SOFR, which is SOFR. SOFR is basically the baseline cost of money for banks. It replaced LIBOR and is based on real secure transactions, not estimates or guesswork. That's why banks use it today. So when a loan is quoted as SOFR plus something, the SOFR part is not negotiable. That's just what the bank's cost of funds is. If you're old enough, that used to be LIBOR plus something. That went away. It's now SOFR. So what is negotiable and the margin on top of it? And that margin reflects the aircraft risk, liquidity, and how easy it would be for the bank to exit the loan. So if a rate falls, a SOFR-based loan resets lower automatically. That's why this matters right now. It's not about locking the lowest rate today. It's about positioning yourself so your financing improves as rates come down. That's the part most buyers miss, and where smart structure beats rate shopping every time. Okay, let's start with a $5 million aircraft. Think light jet, high-end turboprop. If you're dealing with a true tier one lender, a major relationship bank, you're usually looking at something like 70 to 75% loan to value. So on a $5 million airplane, that's roughly $3.5 to $3.75 million financed. Rates are typically SOFR plus something in the 175 to 2.25 range, sometimes fixed. The terms are longer. Amortization 10 to 12 years. And the structure here is relationship driven. And here's the key. At that level, the bank is underwriting you first and the airplane second. And if values soften, they don't panic. They work the relationship. But if we drop down a tier, things change a little bit. So a regional bank, what I'd call a tier 2 lender, might only go to 65 to 70% LTV. Same airplane. Now you're financing closer to $3.25 to $3.5 million, and the rates step up a bit, maybe SOFR plus 2.25 to 300 basis points, and the term softens slightly. And they're going to shorten because these banks execute well, but they're also very, they're less flexible when the markets turn. And aircraft liquidity matters here more. And then there's tier 3, which are the specialty lenders and finance companies, and they still get the deal done, but the loan to value drops to maybe 55 to 60%, and the terms compress to 5 to 7 years, and the rates jump hard. You're not paying for capital risk, you're paying for structure and exit risk, whether you see it or not. Now let's shift gears to a $500,000 aircraft. Think high-end piston. Tier 1 banks can do these deals, but they usually won't unless it's relationship finance. When they do, leverage is lower, maybe 60 to 65%. But this is where tier 2 lenders really shine. This is their market. This is their bread and butter. 65, 75, 85% loan to value is very reasonable here. 7, 10, 12, 15-year amortizations. It's a sweet spot, especially for $500,000 aircraft. Clean, efficient, predictable. Boom, done. Vast majority, probably 80 some odd percent of the tier 2 lenders. That's how they operate. Again, very much relationship driven. Tier 3 lenders will go higher leverage, sometimes 75%, but the rates are going to jump. The covenants are going to tighten. It's a trade-off. It's not a free lunch, right? But tier 3 lenders, what they bring to the table is that they'll do it for less money down, but you're going to pay for it with a higher rate. All right, so let's talk about a $250,000 airplane, because this is where brokers enter the picture. Most banks simply don't want sub $300,000 aircraft, period. I don't care what anybody says. Brokers matter here because they know which specialty lenders are active. You might see 70 to 80% loan to value, 5, 7, 10-year terms, rates that feel a little bit higher because you got to remember the brokers are being compensated, and that's embedded in the rate. These deals get done left and right all day long. It's specialty capital. It's not bank money. And that's the takeaway I want you to remember. As aircraft values drop, structure matters more than rates, and who you work with matters even more than that. Okay, this is the part of the episode where I stop speaking as a host or a commentator and start talking to you as an expert witness. Because the most expensive mistakes in aircraft finance don't happen at closing. They show up later when someone tries to refinance, sell, or exit a structure that was never built to survive contact with reality. And I mean it. Let's start with a non-USPAP valuation and appraisal. Remember, USPAP stands for the Uniform Standards of Professional Appraisal Practice. It's an act of Congress. It is a requirement in lending. You can't get around it. So if a lender is willing to do non-USPAP valuations and appraisals, it's a red flag because it's quietly dangerous. Non-USPAP valuations get used because they're fast, they're convenient, they're flexible, they help deals move, they support the initial loan structure, and they rarely get questioned at closing. But the problem is a non-USPAP opinion won't survive scrutiny when the deal needs to be re-underwritten, right? If a bank gets audited, or when the poop hits the fan, as I like to call it, everything's good until it isn't. Refinancing lenders, credit committees, secondary market participants don't care what supported the original loan. They care what stands up today under recognized valuation standards with a defensible methodology. When a loan is structured off a non-USPAP valuation, the borrower often discovers later that the value that they relied on doesn't exist in the real market. That gap is where refis fail every day and the equity vanishes. Boom, it's gone. Next, let's talk about replacement cost, because this concept gets abused constantly. Replacement cost feels objective. New aircraft prices rise, so values must rise too, right? Wrong. Replacement cost is not market value. It's a reference point, not a justification. Banks that anchor too heavily on replacement costs during strong markets set borrowers up for pain later. When demand shifts or inventory builds, replacement cost becomes irrelevant. Now let's talk about balloons because they're wildly misunderstood. Balloons don't exist to trap a borrower. They exist because banks don't want long dated exposure to volatile assets. A balloon forces a reset, period. It resets value, structure, and the strength of the borrower. The mistake is assuming that the reset will always be easy or to the benefit of the borrower. A balloon only works if the asset, the borrower, and the market all cooperate at the same time. It's not guaranteed. Sounds easy. It's not. Timing a balloon payment is incredibly difficult. I would urge you to and caution you to not do it. And that brings us to a critical misconception. Loan term does not equal ownership horizon. Just because you have a 10 or 15-year amortization doesn't mean you should own the aircraft that long. Financing should match how long you intend to own the asset, not how long the bank is willing to stretch payments. All right, finally, let's talk about covenants. Because the rate gets all the attention, but the covenants do the real damage. There's maintenance triggers, valuation tests, liquidity requirements, insurance clauses. These are provisions that surface when things get super uncomfortable. Most borrowers never read them closely. They don't look at the fine print. So remember, bad financing decisions don't show up at closing. They show up when you try to exit. That's not fear mongering. That's my experience. And understand it early. That's the difference between control and regret. You need to trust me here. I have financed more aircraft than you. I have owned a bunch of them. I have had very large credit facilities, and I've had portions of those called in down markets. It's much different. It's not fear mongering. I'm telling you, it's experience. You got to be careful. Okay, so why is now a really good window for refi? And this is the part of the episode where I think people are going to expect a prediction, and that's not really what this is. But it is about positioning, not timing, because most borrowers fixate on the number, the rate, the spread, the headline. But in real lending markets, direction matters more than the level. Banks don't wait for rate cuts to re-engage. They re-engage before the cuts, when credit committees start feeling confident again. That's when credit standards loosen quietly. Structures improve before pricing does. Flexibility shows up in places borrowers aren't looking yet. And the best refis rarely happen after the headlines. They happen before anybody's talking about them. By the time rate cuts are obvious, lenders have already repriced their risk. But the early movers, they don't get the lowest rate, they get the best structure. And the structure, that's what survives cycles. And the market psychology is shifting. And what I'm seeing now is that sellers are still anchored to yesterday's numbers and that buyers are slowly regaining leverage. I'm seeing a lot of discounts, actually. And banks are testing appetite. They're not pulling back, but they're probing. And I think that combination creates something rare. It's called asymmetry, because deals are being done where sellers haven't fully adjusted, where buyers aren't desperate, and where lenders are willing to engage, but doing so selectively. Those transition periods don't last long. Once sellers reset expectations, leverage compresses. Once buyers flood back in, discipline disappears. Once banks fully reopen, pricing tightens again. Folks, it's mid-January. Flying season is right around the corner. You've got 6 to 8 weeks here. The window isn't obvious, and that's why it exists, which brings us to the anchor line for this segment. You don't win by timing the market. You win by structuring optionally. Optionally means refinance paths, conservative leverage, terms that don't force decisions at bad moments. That's how smart borrowers play uncertain markets. Not by guessing the bottom, by staying flexible when everyone else is locked in. One quick point on Fed and interest rate volatility, because I think this is where people get tripped up all the time. The Fed doesn't move rates in straight lines, and markets don't wait for announcements. Most of the opportunity happens before the headlines. By the time rate cuts are obvious, spreads have already moved and the easy wins are gone. That's why trying to time the bottom in rates almost never works. But what does work is structuring flexibility, loans that reset, refinance cleanly, and improve as conditions change. Because smart buyers don't bet on perfect timing. They position themselves so volatility works in their favor. Okay, so how do I do it today? What are my tactical takeaways? Because this is where I'm going to get very practical, not in theory or forecasts, but just how I'd actually approach aircraft financing today. First, when I'd use a broker. I'd use a broker when access is the problem. Smaller aircraft, older aircraft, non-standard aircraft, thin deals, commercial usage, questionable credit. We didn't talk about that. But if you've got problems with your credit history, use a broker. Or when I'm outside my normal banking relationships, because brokers add value when they know who will say yes, not when they're shopping rates blindly. Second, when I'd go direct. I'd go direct for refinancing for well-known aircraft types and anytime I already have a liquidity or relationship at the institution. If the aircraft is common, if my credit is strong, if the objective is structure, not access to more money, if intermediaries usually add friction, not value. And third, when I refinance, even with a decent rate, I refinance when structure improves, if I can extend my amortization or reduce my covenants or align term with ownership horizon or eliminate future pain at a balloon. And I don't care if the rate is already fine. Rate is temporary. Structure is permanent. Fourth, how I think about term versus exit. I'll never finance based on how long the bank will amortize. I finance based on how and when I expect to exit. If the loan forces a decision before I'm ready through a balloon, a covenant, or valuation trigger, it's the wrong structure for me, no matter how attractive that payment looks. This means you can't afford the aircraft, at least not today. That's what it really means. And finally, why valuation discipline matters more than rate shopping. A cheap loan on a bad value is an expensive mistake. Let that sink in. I want a valuation that survives scrutiny, refinancing, and market shifts, not one that just gets the deal closed. Because bad assumptions don't show up on day one. They show up when you need flexibility. So I'll leave you with this. Finance the airplane you can exit, not the one you're emotionally attached to. And that mindset saves more money than any rate negotiation ever will. Before we wrap up, I want to make one important reminder. Aircraft finance is not car finance. There is no universal rate sheet. There's no one-size-fits-all solution here. Most aircraft loans are tailored to the specific aircraft, the specific borrower, and the moment in the market. That's also why it's impossible to talk about every lender, every broker, every structure in a single episode. If your name or your bank or your firm wasn't mentioned today, that's not a slight. It's certainly not a lack of respect. It's just reality. There are hundreds of active lenders in the United States, each with a niche, a specialty, and a role. The brokers I speak with daily are some of the best in the business. And the number of banks that VREF provides data to is far larger than any list we could ever cover on a podcast. This episode wasn't about ranking everyone. It was about giving you framework to think more clearly. If you're buying, refinancing, or just trying to understand where you fit in this market, and you need help making sense of it, call me or email me. I'll point you in the right direction. And if today's conversation helped you see the market differently, do me a favor, share this episode, subscribe to The Truth About the Market, and remember, when you need accurate, defensible, data-driven aircraft values, there's only one name in the industry to trust. That's VREF. Visit vref.com to get started today. Thank you for listening. I'm Jason Zilberbrand. This is The Truth About the Market. Until next time, fly safe and stay smart.
If you'd like a complete list of all the brokers and service providers, as well as bankers that I referenced in this episode, then you can download a free copy at vref.com/resources.